I'm the lead analyst here at Iron Financial. Welcome. This is the only place where we help you forge a stronger portfolio, not by chasing hype, but by hammering through market weakness. Today, the company on our anvil is Gamehaus, ticker GMHS. Now, this is a stock that is Wall Street completely split right down the middle, and for good reason. On one hand, you see this absolutely explosive headline profit number that makes you want to jump in with both feet. But on the other, the very foundations of the business, the revenue, the users, they appear to be cracking, maybe even crumbling. It's a classic paradox, a real head-scratcher. So our job today is to smelt this company down to its absolute core. We're going to find out if we're looking at a structure built from solid steel or if it's just fool's gold painted to look strong.
All right, let's just cut right to the chase. They call me the Market Skeptic for a reason, and this right here, this is the question that should be keeping every single Gamehaus investor up at night. I mean, think about it. 151% profit growth. That sounds incredible, right? It sounds like a dream come true for an investor. But then, in the very same financial report, buried in the numbers, they tell you that revenue, the actual money coming in the door, dropped by nearly 8%. This doesn't just feel a little off. It pretty much defies the basic laws of business physics. So, what are we really looking at? Is this some kind of financial engineering masterclass? A signal that this is a brilliantly efficient operation that's figured something out? Or is this a house of cards? A company so desperate to post a pretty profit number that it's willing to cut off its own limbs just to make the numbers work for a single quarter? That is the mystery we have to solve today. Is this real, durable strength? Or is it a cleverly disguised trap waiting for an unsuspecting investor?
Exactly. And to solve a mystery like this one, you need a blueprint. You need a plan. So here's how we're going to do it. Our diagnostic is going to start right at the heart of the confusion, the profit paradox itself. Then we'll take our tools and inspect the top line for any and all cracks. From there, we'll put their official strategy to the test. Are they truly forging a stronger core? After that, we get to what might be the most important piece of this entire puzzle, the user engagement puzzle. And finally, after all the evidence is on the table, we deliver the iron financial verdict. There's going to be no nonsense, no hype, just a hard, cold analysis to see if this company is actually built to last. So let's get to work.
All right, let's start right on the battleground itself. The profit paradox. The numbers you are about to see are the entire reason Wall Street is completely torn on this stock. It's because they seem to tell two completely different stories at the exact same time. One story is about incredible, almost unbelievable profitability. The other is a story about decline and weakness. You see, understanding this fundamental contradiction isn't just part of the analysis, it's the only way to truly understand this investment. So let's lay it all out right here.
Okay, just let these numbers sink in for a second, because the sheer force of this contradiction is pretty wild. Look at that top line with me. Total revenue. A year ago, they brought in $28.5 million. This quarter, $26.3 million. That's a 7.8% drop year over year. That's not a rounding error. That's a real decline. Money is leaving the building. But then your eyes drift down to that bottom line, net income, the actual profit. And it didn't just grow a little bit, it detonated. It went from $0.4 million, that's $400,000, all the way up to $0.9 million, a 151.2% surge. Okay, is this some kind of accounting trick? Seriously, this is the kind of math that sets off every single alarm bell I have. It feels like financial alchemy, like they're trying to turn lead into gold. You just cannot tell me that you're losing customers and you're selling less of your product, but somehow your profits magically more than double. A company does not shrink and grow at the same time. It's impossible. One of these numbers is telling a lie, or at the very least, it's not telling the whole unvarnished truth, and we need to find out which one it is and why.
That is exactly the right question to be asking. And to understand the profit, the first thing we have to do is diagnose the weakness. So we're putting that revenue number on the anvil right now, and we're going to look for every single crack. Where is this bleeding actually coming from? You have to remember, a top-line decline isn't just a number on a page. It's a symptom of a deeper underlying issue. Let's find the cause.
And here it is, $26.3 million. I want you to remember that number. It's a 7.8% drop from where they were a year ago. Now, in the grand scheme of things, that's not a 5-alarm fire that's going to bankrupt the company tomorrow. But it is a clear, unambiguous signal that the main sales engine is sputtering. It's losing power. So, before we can even begin to talk about anything else, their profits, their strategy, their future, we have to accept this one fundamental truth. The company is selling less stuff today than it did a year ago, full stop.
And when we actually break it down and look under the hood, the weakness is, well, it's everywhere. Let's look at the primary source of their income, in-app purchases.
This is their bread and butter. It fell 6.4% down to $23.9 million. Then we look at their secondary stream, advertising revenue. It took an even bigger hit. It fell from $3 million last year all the way down to just $2.4 million this year. So think about what this means. This isn't just one part of the business failing while another one picks up the slack. No. This is the entire revenue structure showing signs of being under pressure. This is the reddest of red flags for me. This isn't just one leaky pipe that you can patch up. This looks like the whole foundation is getting wet. It points to a systemic decline. It tells me that their core products, the actual games people play, are losing steam. The magic is starting to fade. People are spending less money inside the games, and at the same time, advertisers are willing to pay less money to reach the people who are still playing them. To me, that sounds like a business that is shrinking across the board. This is the lifeblood of the company, and it's leaking from two different places at once.
And you're absolutely right to be concerned. But here is the company's official defense, and we're pulling this quote straight from their quarterly report. Their argument is that this wasn't some kind of accident. They're saying this revenue decline didn't just happen to them. They claim they actually engineered it. They say they deliberately and with purpose pulled the plug on their user acquisition spending. In simple terms, they basically turned off the big marketing hose that's constantly bringing in new players. They're framing this not as a business failure, but as a strategic, intelligent choice.
Which brings us directly to their core strategy, or at least their stated strategy. They argue that they are in the process of forging a stronger operational core. The logic, as they presented, is that they are intentionally cutting away the weaker, less profitable parts of the business, specifically high-cost, low-return user acquisition efforts, in order to reinforce the foundation for the future. So this section is where we really put that claim to the test. Is this a disciplined, strategic reconstruction of the business, or is it just a demolition in disguise?
Okay, now look closely at this slide. This, right here, this is the engine room, and it holds the answer to the paradox we started with. This donut chart is the source of that massive 151% profit jump. Their total operating expenses are down 10.1% year over year, coming in at $25.4 million. They simply spent less money, a lot less. Let's do the math together. While their revenue fell by about $2.2 million, they managed to slash their total costs by nearly $2.9 million. That $700,000 difference between the two, well, that drops straight down to the bottom line, boosting their profit. It's just simple, almost brutal arithmetic.
And here it is. This is the single biggest lever that they pulled to make that math work. Their selling and marketing expenses were slashed by a massive 18.4%. They didn't just trim the budget, they took an axe to their advertising spend. And this connects directly back to that strategic statement we just looked at. They said they were going to cut user acquisition spending, and these numbers prove they did exactly that. And they did it aggressively. This move right here, this single decision is the absolute key to understanding their entire story. This is the move that simultaneously tanked their revenue and sent their profits to the moon.
But, and this is a crucial but, this is the part of the story that the bulls, the optimists, are pointing to. This is their evidence that this is a real strategy, not just a desperate fire sale. While they were torching the marketing budget for old games, they weren't cutting everywhere. They actually increased their spending on research and development by 7.5%. The narrative they're trying to sell to Wall Street is clear. This isn't just about destruction. It's about a strategic reallocation of capital from selling old things to creating new things. They're taking money away from marketing their older, maturing games and reinvesting it to build the next generation of games, specifically in the RPG and puzzle genres.
Whoa, hold on a second. A pivot to R&D? That makes sense on paper, but what is this? General and administrative expenses are up 65.5%. You can't just gloss over a number like that. They're trying to tell us a story about discipline and efficiency, about cutting the fat and being lean, but their corporate overhead just exploded. It skyrocketed. So how does a company that's supposedly focused on disciplined adjustments let their administrative costs balloon by nearly 2/3 in a single year? To me, that looks like a massive crack in their whole efficiency story. Where in the world is all that money going?
And that is a perfectly fair challenge. The company's justification for this spike is that this is a structural investment, not operational waste. They're essentially telling investors that this is the cost of growing up and becoming a more mature public company. They claim that money went into things like improving corporate governance, building out their finance and legal teams, and strengthening their investor relations department, all the boring but absolutely necessary infrastructure that a public company needs to function properly and transparently. They want us to see this as a one-time construction cost, like building a stronger corporate foundation, and not as a permanent bloat in their corporate overhead.
Okay, fine. Let's just say, for the sake of argument, that I tentatively accept the financial reorganization. We're still left with what is, to me, the most fundamental and glaring problem. You can sit there and polish the financial engine all you want, but if you're running out of fuel, it really doesn't matter how shiny the engine is. This is a gaming company. And a gaming company without gamers, well, it's a hollow shell. It's nothing. So enough with the spreadsheets and the cost structures for a minute. Let's talk about the players. Let's talk about the human beings. Show me the user data.
And this slide right here brilliantly illustrates the entire story. This solves the puzzle we started with. On the left, you see the direct and, honestly, the brutal consequence of slashing that marketing budget. Average monthly active users, down 28%. Average daily active users, down a staggering 30%. Their 7-day retention rate is also down, meaning fewer new players are sticking around. It's an undeniable, almost catastrophic collapse in their overall user base. But now look at the right column. This is the other side of that same coin. This is the trade-off laid bare for us to see. They are absolutely bleeding casual free-to-play users by the thousands. The people who just log on to kill a little time are leaving in droves. But their core, dedicated players, the true fans who actually spend money, are not only staying, they're spending more money than ever before. Average revenue per daily active user is up an incredible 28.6%. And their payer conversion rate, the percentage of players who actually spend money, has improved from 2.1% to 2.5%. Their strategy is now crystal clear. They've abandoned the idea of building a massive army of casual players and are now focused entirely on a smaller, more elite squadron of high-value paying customers. It's a pivot from quantity to quality.
And there you have it. The full picture is now on the table. A shrinking user base and falling revenue, being propped up by brutal cost cuts, and a small but very dedicated core of super users. Now is time to put all of these pieces on the scales and weigh them. It's time for the iron financial verdict. Is this strategic pivot building a financial fortress that can support future growth? Or is it all just a facade, a trap waiting for unwary investors to fall into?
All right, let's break this down point by point. The bull case here is clear. And you have to admit it's compelling. You have a management team that is showing incredible discipline. They've dramatically improved their profitability, they've quadrupled their operating margin to 3.3%, and they're proving they can make their existing users more valuable, with an ARPDAU of nearly 57 cents. On top of that, they have a healthy cash position of over $17 million, they're actively buying back their own stock, and they are reinvesting in the future through R&D. From a purely financial standpoint, this looks like a company that is building a rock-solid financial fortress. A fortress that might have no one left inside of it. Come on. The bear case is just as powerful, if not more so. You simply cannot ignore a 28% drop in your user base. For a gaming company, that's a 5-alarm fire. You can't monetize users that you don't have. This steady decline in revenue is like a long-term cancer on the business, and their guidance for next quarter is even weaker, projecting sales as low as $24 million. By turning off the growth engine completely, they risk becoming totally irrelevant and losing precious market share that they may never, ever get back. Let me be clear, you cannot cut your way to greatness forever. At some point, you have to actually grow the business. This looks less like a turnaround and more like a company that is just managing its own decline.
So the iron financial verdict is this. Gamehaus is a high-risk, high-reward bet on a very, very difficult turnaround. That 151% profit jump is not financial magic. It is the direct result of a calculated, and you could say painful, strategic choice. Management has, without a doubt, successfully fortified the company's financial foundation. The balance sheet is stronger, the margins are healthier, and they have the capital they need to invest in new products. But the cracks in the user base are real and they are deep. This is absolutely not a safe stock. This is not a buy-and-forget investment for your retirement account. This is a bet, a pure bet on management's ability to execute a nearly perfect pivot, to launch brand new, successful games that can find growth on this smaller, more profitable, but much more fragile foundation. So the multi-million-dollar question for every investor looking at this stock is this. Do you bet on a shrinking company that has a fortified balance sheet and only the promise of a turnaround? Or do you stay on the sidelines and demand to see actual proof of new growth before you put your hard-earned capital at risk? Your answer to that question determines if this is a golden opportunity or a cleverly disguised value trap.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.